The average service member leaves the military with under $100,000 in savings, while the top 10% retire with assets exceeding $1 million. Like planting seeds that will grow into the financial forests, the difference comes from strategic use of military-specific tools. I've mapped out how two identical military careers can diverge financially. Through smart TSP contributions, the VA home loan strategies, and using some of the benefits of the Service Members Civil Relief Act, or SCRA, the wealth differences exceeds $800,000. And the best part is, these powerful financial decisions can be made by every person in uniform. If you stick around to the end of this video, I will share with you how you can get to a $1 million TSP balance in 15 years. What if I told you two service members with identical rank and pay and circumstances can end up with an $800,000 wealth difference by retirement? The choices they make during their military careers could lead to dramatically different financial futures. Let me introduce you to Sergeant Jones and Sergeant Baker. Both are E7s with 10 years of service in 2025, earning the same base pay of $5,106 monthly. They've reached this milestone together after multiple deployments and similar career paths. Jones often talks about traveling the world with his family, while Baker dreams of settling down on a beautiful piece of property in Georgia. Despite these different aspirations, they start with nearly identical financial situations. Both have about $5,000 in savings and similar debt levels. Their financial journeys begin to diverge with their approach to the Thrift Savings Plan. Sergeant Jones takes the common approach, contributing 5% of his base pay to the TSP. This secures the full government match, which Jones considers sufficient. His monthly contribution amounts to $255 towards retirement. Sergeant Baker, however, became a RINO and took advantage of his membership, which changed his perspective. He decides to contribute 15% of his base pay, or $765 monthly, to his TSP. Baker plans to maximize his contributions as much as possible with an elective deferral limit of $23,500. This single decision plants financial seeds that will grow dramatically different money trees over time. Like roots that appear similar in their early years but develop into vastly different sizes at maturity, their investment strategies yield profoundly different results. Here's the financial secret that makes all the difference. Using a conservative 5% average annual return, Jones's approach would grow approximately $164,000 over 20 years of service, a respectable sum, but nowhere near his potential. Meanwhile, Baker's 15% strategy would accumulate around $452,000 under identical market conditions. That's a $288,000 difference. The gap widens further when considering tax advantages. Baker's larger Roth TSP contributions reduce his taxable income when he's ready to take distributions, keeping more money in his pocket at a time when he's probably no longer trading his time for money. The most revealing aspect of this comparison is how Baker's modest additional monthly investment, $510 more, transforms into nearly triple the retirement assets. This wealth gap represents fundamentally different futures, one with financial security and options, another potentially requiring tough choices and continued work. Though the military provided both sergeants identical opportunities, their different approaches using these benefits created dramatically different outcomes. That $288,000 TSP difference is just the beginning. Did you know the government gives service members a wealth building tool so powerful it can create over $500,000 in additional net worth? Yet 68% of military families completely miss this opportunity. The military lifestyle comes with unique challenges, particularly the frequency of moves. Service members relocate 2.4 times more often than their civilian counterparts. And these PCS orders represent extraordinary wealth building opportunities when approached strategically. The $1 million multiplier effect when combined with the TSP advantage. Every 3 years, both our sergeants face similar housing decisions when new orders arrive. Jones follows conventional wisdom, selling his current home, using his VA home loan benefit for the next one, and repeating this cycle with each move. Baker, however, he sees these relocations as the foundation for building a real estate portfolio that strengthens with each new assignment. Upon receiving his PCS orders, Baker makes a pivotal decision, keeping his first home as a rental property. Most service members don't realize that they can maintain multiple VA loans simultaneously under certain conditions. The VA Home Loan Program provides caps on how much money you can leverage before your certificate of eligibility is all used up. If Baker takes out a $210,000 mortgage, he maintains sufficient entitlement to purchase another home at his new duty station. To qualify, he demonstrates he can afford both the mortgage payments, which becomes easier as soon as his first home generates rental income. By his fourth set of PCS orders, Baker has accumulated 4 properties in 4 different housing markets, 4 properties appreciating simultaneously, 4 mortgages being paid down largely by tenants, and 4 income streams flowing into his account. Meanwhile, Jones sells each home when he moves, missing years of appreciation in military markets where incoming service members consistently drive property values higher. Sometimes Jones sells at a loss when market timing works against him, erasing his equity. Baker also leverages the Service Members Civil Relief Act, or SCRA, for debt management. This legislation caps interest rates on pre-service debts at 6%, providing significant savings that Baker channels directly into accelerated debt paydown. Within 2 years, he eliminates his high interest debt completely, freeing up that capital to improve his rental properties. Jones carries significant credit card debt at 18% interest, dramatically hindering his wealth building. Each month, hundreds of dollars go toward interest payments instead of investments or additional mortgage principal. The retirement outcomes tell the story. Jones owns a home with perhaps $120,000 in equity if he's fortunate with market timing. Baker transforms his military career into a real estate portfolio worth over $640,000 in combined equity. His 4 properties generate approximately $3,500 monthly in passive income after expenses, which nearly matches Jones's full pension. Baker's strategic real estate decisions create a $520,000 advantage over Jones through $420,000 in additional equity, plus the present value of his passive income streams. Combined with the $288,000 TSP advantage we discovered earlier, Baker's financial posture is strong, while Jones's financial future remains vulnerable to economic uncertainty. So what separates our 2 sergeants isn't some hidden secret or family inheritance. It's about making strategic financial decisions that are available to every service member wearing the uniform today. I appreciate you for sticking around to watch this episode, and as promised, here is the case study where we explain how you can get to a $1 million TSP balance in 15 years. To gain access to a video explanation and the PDF, click on the link in the description of this video to start your journey toward financial independence. And before you leave, ask yourself this question: which financial future will I choose? The most successful military retirees systematically leverage their unique benefits, maximizing TSP contributions, using VA home loans strategically across duty stations, and applying SCRA protections to eliminate high interest debt. This combination can save thousands in interest payments while transforming a standard military career into $1 million financial foundation. Your path to financial independence begins with your next LES. The question isn't whether these wealth building strategies work, it's whether you will implement them. Now let's get to the Q&A portion of the show. Atsushi, what questions do you have for me?
So here's the first question. The first question is, what is the difference between a Roth TSP contribution and a Roth IRA contribution, and can you be able to contribute to both?
Yes, that's a great question. So the difference between a Roth TSP and a Roth IRA is that one, the TSP is an employer-sponsored plan. So think 401k, 403b, 457. These are all codes within the Internal Revenue Code that allow employers to provide retirement accounts to their employees. So the biggest difference there between the employer-sponsored and the individual retirement account, which is what someone can purchase or open, on their own through their own bank, a brokerage firm that they use, is the contribution limit. The employer-sponsored plan, in this case the TSP, has a $23,500 contribution limit. It's called the elective deferral, and that is set by the IRS annually. So in the year 2025, that amount is $23,500. For an individual retirement account, or an IRA, that is $7,000 per year. You are able to contribute to both. And so if you have the ability, I highly encourage people to max both of those employer-sponsored and individual retirement accounts out. I also recommend, because you mentioned Roth, to contribute to a Roth account. So the Roth allows you to take distributions when you're ready to take distributions in retirement out tax-free. The traditional allows you to take a tax deduction it decreases your adjusted gross income the year in which you make a contribution. So every single year you're contributing to your employer-sponsored plan or your individual retirement account. As a traditional, you are able to take deductions. But when you go to take distributions, when you're receiving money from those accounts, you have to pay taxes on the distribution. And so if you're doing this thing right, you should expect to retire with enough money that it makes sense to go ahead and plan now to be in a higher tax bracket, which means you do not want to have to be paying taxes when you're ready to take distributions. So I encourage people to invest in the Roth version of the employer-sponsored or the individual retirement account for that reason.
My next question is, turning a PCS moves into a real estate portfolio sounds powerful, but what about the risks, like vacancies, bad tenants, or unexpected repairs? How can someone like Baker mitigate those to ensure that strategy pays off?
That's a great question. So there are definitely risks inherent with any investment. The best way to mitigate risk in real estate is to increase your financial literacy and IQ. And the way that we encourage people to do that is to become a RINO. If you open up a Club RINO Plus account, you will gain access to 4 courses, one of which is the real estate investment course. That's where we teach you how to identify property, how to identify your risk tolerance and match the market to your risk tolerance, and how to set smart financial goals. Those are specific, measurable, achievable, realistic, and time-bound goals. Once you have those 3 things, you'll be able to start the journey toward acquisition of real estate investment properties. The way that I encourage people to mitigate risk in addition to that is to partner with someone that has experience. So by becoming a RINO, you have that information. By becoming a client, you're able to leverage my experience as a real estate investor. I was able to purchase 5 properties from thousands of miles away, and I was able to do that relatively effectively because I had a mentor the entire time educating me on the things that he was doing in his real estate investment journey. So now I'm that person for all the clients that decide to partner with us here at RINO Invest. Of course, there's going to be risk in any investment that you make. I would argue that the risk that you take in real estate is higher, but the reward is significantly higher than it would be in the other asset classes, being securities, if you were to start a business, or if you were invested in commodities. And so that's basically, what I would tell folks. Educate yourself, partner with someone with experience. Once you get experience, you'll be able to mitigate the risk to a level that is more than acceptable to your risk tolerance.
And the next question is, in the example with Bakers and Jones, when Baker retires, he got a solid financial base, but Jones might need to keep working. What financial steps should a service member take into their final few years of service to smooth the transition to civilian life, regardless of which path they followed?
Great question. If you are still in uniform, you have not retired yet, so you still have the option to stay in past 20, I would take a very realistic and accurate assessment of your current financial situation with a financial planner. Do not do this by yourself, right? Because we all have biases. Even financial planners have biases. I would highly encourage you to get somebody else with an unbiased opinion to look at your financial situation and tell you where you are today. And then you need to sit down, if you have a spouse, sit down with your spouse and figure out what type of retirement you'd like to have. Not how much money you'd like to have in retirement, but what kind of retirement would you like to have? You'd like to vacation internationally twice a year. You want to purchase a new car every 3 years because you enjoy nice cars and the technological advances that come with. You want to spend more time in your church. You want to spend more time with your family. Whatever your retirement goals look like, spend some time figuring out what those are. And once you've done that, then allow that financial planner to quantify what that vision looks like. How much is it going to cost to get a new car every 3 years? How much is it going to cost to fly the family to Europe or Africa or Asia twice a year for a week or however long you expect to travel? And then once you have that quantified goal and your current financial situation, you can back into how long it's going to take you to get there. You might find that you are right on track. You're 2 years away from retirement and you don't have to spend any extra years in the military in order to achieve your stated smart financial goals. You might also find out that you need to spend 3 or 4 more years. So instead of doing the 20, you do the 24 years in order to get to your stated smart financial goals. If you're in, you definitely want to make that accurate and real assessment of your current financial situation. You want to be thinking about what your retirement life looks like, and you want to do that with a financial professional, with a financial planner. If you're already out, right, if you no longer have the option to stay in because you've already ETS'd, you've retired, you received your DD-214, then I would encourage you to still figure out your current financial situation, figure out your smart financial goals, and then depending on how far away you are, look at some upscaling opportunities. The VA is really good about providing education benefits. They're not very good about the ease in which you can gain access to them, right? You gotta jump through the bureaucratic system, but once you understand what's afforded to veterans through the VA, through a bunch of different programs that are provided by the state, depending on the state in which you live, state benefits exist for veterans, then you might be able to upskill yourself into a totally different profession or get certifications in the profession that you're already in completely free. And so I would highly encourage you to use resources like Military OneSource and just call them, ask questions, and they can put you in contact with someone who has better answers for your specific situation. So that's what I would recommend people do who are currently in and are about to get out, and people who have already separated and are looking to figure out what they need to do to get to their stated smart financial goals.
Next one is about market timing. Let's say you sold home at a loss due to bad market timing. How can service members assess whether it's a good time to sell versus hold onto a property during a PCS move, especially in volatile housing markets?
I don't recommend that people sell. I recommend that before they buy, they do that with the understanding that they expect to keep the property and rent it. Buy it and you want to hold it and you want to rent it until it cash flows significantly. And it should cash flow at least a few dollars from day one. Because what you're able to do is when you invest in real estate, you fix a majority of your expenses. Of course, there's going to be turnover, so you got to account for vacancy. There's going to be repairs because your tenants are going to, walk on the carpet. They're going to put clothes in the closet, and things are just going to be worn out over time. So there's going to be repairs. Depending on the age of the property, there's going to be capital expenditures that you have to set money aside for. You account for all of that in the pro forma. Once you've accounted for all of that in the pro forma, and you still have a positive cash flow, that is when you really make your money. You make your money on the buy, not on the sell. And so I encourage people before they even buy to look at a pro forma, put that property that they're considering into a pro forma. We provide that in the Club RINO Plus membership, and figure out what cash flow might look like if you decided to rent it when you PCS in 2 or 3 years. If you've already purchased the property when you're watching this video and you're about to PCS and you're trying to figure out, how to mitigate the losses because you spend so much money in expenses on just fixing up the property. You spend a lot of money maintaining the property for 3 years. And so you're probably thinking, I spent all this money in this thing, and by selling it, I'm gonna now have to pay a realtor 3 or 6% to sell it. That's gonna eat into my profit. I may have to have some seller concessions to get the buyer to, close. All these different things can eat into the equity or into the profit of the sale, and you might end up losing money. If you're in that situation, I would encourage you to make sure that you do not have the ability to rent the property. So before you are solidified in your decision to sell this property, start looking at other options to retain it for a year, maybe market conditions can change, and then rent it, and then look at what that math looks like. So if you end up renting it at a break-even point, then that's great, right? Prolonged your ability to make money from the property by pushing out the sale a year out, which means the markets could change, the value of the property could go up, or it could turn into a seller's market. You no longer have to provide seller's concessions, and that's significant and sufficient enough for you to go ahead and sell that property at that point. If the numbers still don't work out, then this is a hard lesson to learn, but you'll know moving forward what you need to be doing on the buy side. You might have to take that loss now and just consider it the admission or the tuition payment in your financial education journey. And then the next time you PCS and you're looking to buy, make sure you buy with the intent to rent. Before you even close, make sure you buy with the intent to rent. And so that's what I would recommend to people who are about to PCS, who haven't purchased a property, and who are about to PCS and are looking to sell their property.
This is going to be the final question. I understand that RINO Invest is looking for people in E7 and above. What about people who's starting off from E1, or maybe they're in E6 right now? How can we prepare ourselves to work with RINO Invest when we hit E7?
We are big on increasing the financial literacy and IQ of everyone that we meet. And so if you are junior, before you start your financial independence journey, you need to know where you're going. By becoming a Club RINO Plus member, you will have the ability to create those smart financial goals in a way that is conducive to actually starting about accomplishing them, right? The things that get written down are the things that usually get done. And so we make it very, very easy for you to write those things down, which increases the probability that they will get done. And then we give you the tools and the resources to understand all the options that are out there. There are 4 different asset classes out there, and then there are subcategories underneath those asset classes. There's real estate, there's business, there's securities, and there's commodities. Everything falls within those 4 buckets. And so which one of those 4 asset classes best matches your innate abilities and your risk tolerance? If you love research and you love being the subject matter expert in everything that you do, you might be a person that's perfect for commodities investment. If you love people and you love processes and you love figuring out problems, you might be perfect for entrepreneurship, starting a business, or purchasing a franchise and running the system that's been created for you. If you are more of a passive investor, you like to look at other things in your life because other things are always happening, right? And you value spending time with family and friends, and you can take a little bit of a hit in terms of the return on your capital, you're probably perfect for securities because that's a much more simple and streamlined process to investment. You are dollar cost averaging. Every month you're putting $500, you're putting $1,000, however many dollars that you're able to put away. You're contributing it to a securities account, index fund, mutual fund, your TSP, your IRA, whatever it is. And then you're going to spend your time doing something else with the understanding that the maturity is 10, 15 years away. So you're not really worried about market conditions. You're worried about other things that are happening in your life. If you really want to achieve financial independence as soon as possible and retire early, financially independent, retire early, which is what we are all about, real estate has to be the asset class for you. It pays you in 5 different ways. You've got the income from cash flows. You've got the depreciation expense, which is a massive tax shelter strategy. You've got equity growth. So as you are paying down the mortgage on the property, equity is increasing. You've got appreciation, which usually keeps up with inflation, which is why real estate is a great hedge against inflation. And then you've got leverage, the ability to control 100% of the property, having only put down 20% of its value. And so if you do that enough times, you'll be able to grow your portfolio much faster. So I say all that to say to the young E1 or the young E6 out there that there are a bunch of opportunities out there, a bunch of different things you can do. Do not fall into the TikTok and the Instagram wormholes. You really want to figure out what your goals are, and then you want to figure out what your innate abilities are, what your risk tolerance is, and then pair those 2 things up to take advantage of the right asset class for you. And then as you continue to advance in your military career and you are earning more money, you can start to really take advantage of whatever asset class that you've decided on. All right, everybody, thank you for watching another episode of Military Money. My name is Cassian Nuñez, and I would like to remind you to seek real education, invest in performing assets, get rid of bad debt, and provide oversight to those assets.
The RINO Invest and Cash In with Cassian YouTube channels are hosted by Cassian Nuñez. Cassian Nuñez is a financial planner with RINO INVEST Wealth Management. RINO INVEST Wealth Management is a registered investment advisory firm regulated by the Securities Division of the state of Georgia in accordance and compliance with the securities laws and regulations. RINO INVEST Wealth Management does not render or offer to render personalized investment or tax advice through the RINO Invest and Cash In with Cash In YouTube channels. The information provided is for informational purposes only, may not be suitable for all investors, and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.